What if I told you that the economy was collapsing and the stock market was so detached from reality, we'd see a massive plunge in the coming months? These aren't my words. These are the words of economists who see a K correction being the inevitable outcome for the US stock market. We are at such an uncertain time in history, I hope you pay attention. This information may just save your life savings. Let's get it. Welcome to BitBoy Crypto, the hardest working channel in all of cryptocurrency. If you're new, hit that subscribe button and check the description for links you can use to connect with me and the Bit Squad. All right, guys, today we're going to discuss the mammoth in the room and the coming extinction level event plaguing the Federal Reserve and the U.S. financial system. But first, if you haven't watched the first video in this series to better understand what is being discussed, please make sure that you click above. Because we don't have time to recap everything in the last video, which expressed the history of U.S. central banks. Second, I'm not trying to scare you with spooky stories. I'm going to prove to you in a number of ways what's coming is inevitable, and you should have started preparing yesterday. Alessio Rastani, a YouTuber who analyzes the Bitcoin and stock markets, recently had a video discussing how the V, U, or L recovery paths are all dead dreams. This leaves the K recovery, which is essentially the rich getting richer and the poor getting poorer. We are going to discuss why that's the case and how we got here. If you want to watch Alessio's video, you can do so by clicking above. Oh, and before the comments start,
BitBoy's a doomsday prepper who just wants to profit off all the clicks and sell you supplements. And he believes in the Illuminati.
I believe in the reality of money and facts about the market, you silly trolls, and I don't sell supplements. Now pipe down and listen. As previously said in the last video, the Federal Reserve was created to control or steady the economy through inflation and deflation. However, what was done since its creation has resulted in the biggest bubble in history in all markets from bonds to mortgages and especially the stock market itself, with an added bonus of the US dollar not being backed by the gold standard. In other words, it's the perfect storm and it can strike at any time. In 2002, prior to the credit crisis of the 2008 collapse, former Fed Chairman Alan Greenspan summed it up. He said, "It was the case that the price level in 1929 was not much different on net from what it had been in 1800. But in the 2 decades following the abandonment of the gold standard in 1933, the consumer price index in the United States nearly doubled. And in the 4 decades after that, prices quintupled. Monetary policy unleashed from the constraint of domestic gold convertibility has allowed a persistent overissuance of money. As recently as a decade ago, central bankers, having witnessed more than half-century of chronic inflation, appeared to confirm that a fiat currency was inherently subject to excess." So remember, this was prior to the bubble that caused the 2008 collapse. However, this all really started in 1913 when things began to change with the establishment of the Federal Reserve Bank. The Fed, with its monopoly on printing money, was created to guard against market turbulence in the private banking system, specifically in response to the Wall Street and banking depression of 1907 to 1908. The concentration of this kind of power was extremely controversial at the time. President Woodrow Wilson, who signed the Federal Reserve Act in 1913, was quoted just 3 years later saying, "I have unwittingly ruined my country. The growth of the nation, and therefore all of our activities, are in the hands of a few men. We've come to be one of the worst ruled, one of the most completely controlled and dominated governments in the civilized world." Without getting into the politics and history of it all, as we did previously, it was this concentrated power grab that was pitched as decentralization at the time, which has led to the situation we're in today. The Federal Reserve began profoundly changing the nature of money. In its first 7 years of its operation, wholesale prices of goods in the U.S. rose more than 240%. Not surprisingly, between 1914 and 1920, the currency in circulation had increased 242%. Between the Feds printing money more rapidly than in the past to pay for expanding government spending and the U.S.'s total desertion of the gold convention standard in 1933, the value of $1 in 1913 would be less than 1 cent now. By just 2004, inflation had greatly destroyed over 95% of the dollar's value in less than 100 years. The dollar's steady decline in purchasing power has come to be accepted as normal. As the following chart illustrates, the majority of the inflation occurred since 1915. On top of that, our federal debt is so big that is hard to fathom. From the beginning of our nation in the late 18th century till the mid-1970s, roughly 200 years later, our accumulated national debt was less than $1 trillion. This takes into account the Revolutionary War, the Civil War, the World Wars, the Great Depression, the Korean War, and Vietnam. Now, however, our debt was just recently calculated at a federal debt held by the public of $20.83 trillion, and intergovernmental holdings were $5.88 trillion, for a national total debt of $26.7 trillion. Prepare to have your mind blown. To put that into perspective for you, in 2004, that number was only $7.5 trillion, according to the Treasury Department. That means in under 20 years, we've more than doubled our total national debt. Now for the super bad news. Since the pandemic that shall not be named because of YouTube's algorithm, the US has had its federal debt pushed to levels not seen since World War II, and the country's national debt is about to eclipse the economy, according to ABC. The Federal Reserve announced in March that it would pump several $1 trillion into the financial markets by continuing its so-called quantitative easing, purchasing assets directly in the financial markets to support asset prices, while also buying about $1 trillion worth of bonds from big companies, either directly or indirectly in secondary markets. As a temporary solution, it's working. Trillions of dollars spread around by the Fed now support not just stock prices and corporate bonds, but even junk bonds, real estate investment trusts, and private equity firms that continue to borrow at rock-bottom rates. Earlier this year, the Winklevoss twins said, from July 2009 up to the pandemic, the line item for mortgage-backed securities on the Fed's balance sheet grew approximately 3x, from $545 billion to $1.6 trillion. Similarly, the book entry for treasuries with a maturity date of greater than 5 years grew almost 3x, from $315 billion to $872 billion. Together, these assets represent $1.6 trillion printed out of thin air. The Winklevoss twins go on to state that just the recent moves by the Fed due to the pandemic has caused hyperinflation. Examining the Fed's balance sheet uncovers that it added $344 billion more mortgage-backed securities and $820 billion more long-term treasuries from February 2020 to July 2020. In other words, of the $3 trillion increase, $1.1 trillion was printed. The Fed printed 2/3 as much money in the last 6 months as it did over the prior 11 years. While predicting a stock market collapse is a bit like rubbing a crystal ball, I feel very confident in stating that the U.S. economy is about to collapse, and with it, the stock markets will come back to reality. This next crash is going to devastate a lot of people. Statistically, already more young adults are living with at least one parent than at any point in documented American history, including the end of the Great Depression, according to a new poll from the Pew Research Center. Don't let that be you. It's okay to move out of the basement. The Labor Department has also said 884,000 Americans filed first-time jobless claims last week. This number came in worse than expected, as economists thought the filings would decline to about 850,000. In total, unemployment hovers at around 8.4%, and many businesses remain crippled at this time. That's almost 10% unemployment, a nightmarish scenario. So while the stonks are increasing, the economy itself is collapsing. Additionally, the Washington Post's Heather Long identified a red flag in the report: a jump in claims from the Pandemic Unemployment Assistance Program that's primarily for gig workers and those who are self-employed, which implies many still can't find steady work. There were about 839,000 pandemic unemployment assistance claims last week, which, according to the Post, was the second straight week that figure marked a significant increase. In 2020, the projected GDP deficit is 17.9%, and it could be even larger if Congress approves more spending increases, stimulus packages, or tax cuts in light of the pandemic. Well, is that considered a large deficit? Yes, according to Brookings Institute, the projected 2020 deficit is very large. Deficits over the last 50 years have averaged just 3% of GDP. Even during the Great Recession, the largest deficit recorded was just 9.8% of GDP. But the main question is, what are you going to do with all this information? Well, the best thing you can do is to pay attention and be prepared, because a lot of people are going to get caught with their pants down, and that's going to be quite awkward. But now it's your turn. How do you think the pandemic is affecting crypto? Do you think the stock market will continue to rise, or is it primed for a collapse? Let me know what you think in the comment section below. I hope you enjoyed this video. If you did, please make sure to smash the like button and hit subscribe to become a member of the Bit Squad. Thank you so much for watching. Have a blessed day. BitBoy out.